Hey folks, and welcome back to another video on my YouTube channel. I hope you're all doing well. And in today's video, I will be going over the Ict mitigation block. So a mitigation block is a block that forms when a market structure shift is created, and much like the Ict breaker block. Actually, I think the only difference between a breaker block and a mitigation block is that on a breaker block, you have a high and a higher high, and then a market structure shift. On a mitigation block, you would have a high, a higher low, and then the market structure shift. This is a bearish mitigation block example, of course, right? So in a bearish mitigation block scenario, you would find or look for the M pattern. This is something Ict mentioned, just because some people find it easier to find stuff when it is in patterns. And it kind of looks like an M. So find the M pattern, or just the two highs with one of them being lower. And then find the short-term low that created the market structure shift. That will be this one, right? And then the last down close candle is your bearish mitigation block, okay? So this right here would be our mitigation block. And remember that when you look for bearish PD arrays, you would always want to look for them in premium, because we always want to sell in premium and buy in discount. And in a bullish mitigation block scenario, you would have a low followed by a higher low, and then the market structure shift to the upside, right? So in this case, you could look for the W pattern, I guess you could call it, because it kind of looks like a W. But it is just two lows, with this one being higher than the previous one, right? And then find the short-term high that created the market structure shift, which is this one. And then the last up close candle is your mitigation block. So in this case, this will be our mitigation block, right? And the reason that it's called a mitigation block is because, let me go back here, is because it punishes the traders who went long right before the market structure shift happened. Okay, so right here at this short-term low, a lot of people, retail traders, went long, right? And what happened was they probably went into drawdown here, unless they took very fast profits, which they probably didn't. So they went into deep drawdown. And when price returns to this area, our mitigation block, but their entry, right? They entered off of here. So when price returns to that, that is our short signal, right? Because we entered the mitigation block. But what a lot of these long traders would have done when price returned to their entry level is close their position to mitigate their loss, right? So that is ultimately why it is called a mitigation block. I just wanted to tell you that real quick so you understand why we are trading the mitigation block. But let's jump into some charts to look at actual examples on a real chart and not just some stuff that I drew out. So yeah, let's do that. As we can see, we have a bullish mitigation block. The reason for this is that we have a low and a higher low and a market structure shift that happened right here, which our mitigation block is the last up close candle, which would be this one right here, right? So that would be our mitigation block. So this would be a bullish mitigation block, remember, because the low is higher than the previous low, right? And then if we go and look at a bearish mitigation block example, we would be left with something like this, right? We have a market structure shift that happened here. We have a high followed by a lower high, and then the last down close candle, because it is a bearish mitigation block, is your mitigation block, right? So this is the last down close candle, which would be your mitigation block. And some people, you will see, draw them like this. They like to draw it from the lowest point. Sorry, my Fibonacci tool is messing with me, or my rectangle tool. So you'll see some people like to draw them like this, which is personal preference. I sometimes do that, but ICT recommends that you draw it from the last down close candle in bear scenarios and last up close candle in bullish scenarios. But something I do want to add to make this higher probability is, of course, as I mentioned in the beginning, the premium discount tool right here. So this mitigation block was in premium, and because it is a bearish mitigation block, that is optimal. That is what you want to see. So that adds to your confirmation. What you also could do is take your optimal entry level. I got to reverse this. Hold on. Right. From the high to the low. And because we hit the optimal entry levels on the Fibonacci tool, this also adds to our confirmation that this is a good opportunity to go short. The optimal trade entry Fibonacci tool, these 3 levels here are generally levels where price has a higher probability of reversing off of. So if your PD array aligns with that, that is just extra confirmation, right? And there's the Fibonacci tool settings if you'd want to copy it. So that is basically all there is for the mitigation block. I try to make these videos as short as possible. Because a lot of people like to overcomplicate things, but it's very simple. And this is even more simple if you already knew what a breaker block was. But in case you didn't, you should know what both a breaker block and a mitigation block is now. So that is all for this video. I hope you enjoyed. And as always, I appreciate the feedback. And until I see you next time, stay blessed and bye-bye.